All right. Good morning, everybody. My name's Galilea, and I'd like to welcome you all to today's webinar, Exit Ready Financials, Would Your Business Pass Buyer Scrutiny? We're excited to have you all join us this morning. Beautiful morning here in Southern California, as we can all attest. I'd like to thank our presenters, Brennan Durrod and Joshua Walters, as well as our moderator, Dora Lanza, for sharing their knowledge with us today. Just before we get started, I'd like to cover a few housekeeping items. Please note that this webinar is being recorded. We will share the recording with you after the session so you can revisit the content whenever you'd like. Additionally, any information presented today is for educational purposes only. It shouldn't be considered legal or financial advice. Please address any specific questions or concerns with a qualified professional in that respective field. Also, feel free to share your questions throughout the presentation. The presenters will do their best to address them as they come up. And if we can't get to your question right away, we will set aside a few minutes towards the end of the webinar to cover those as well. And if there's anything we haven't answered by then due to a time limitation, we'll make sure to reach out via email with answers to your questions. But on that note, I'll hand it over to Dora to start us off.
Good morning, everyone. Thank you, Galilea. I am Dora Lanza. I am one of the co-founders and chief operating officer of Plethora Businesses. And for nearly 3 decades, we've had the privilege of working with business owners and in one of the most important milestones in their business journey, when they make that decision to sell their company. And as businesses grow, financial complexity grows with them, and buyers place tremendous value on clear, reliable financial reporting and strong financial leadership. And that is what prompted us to invite Josh and Brennan today. I think this conversation is timely. We'll be exploring how a fractional CFO can help companies strengthen that decision-making process, improve financial visibility, and prepare for growth and ultimately an exit. Joining us today are Brennan DeRod and Josh Walters. They are from Vessel Advisors, and they work closely with founder-led companies to provide CFO leadership, strengthening their financial infrastructure, and helping management make better strategic decisions. So, Brennan, tell us a little bit about yourself, and then we'll pass it over to Josh.
Sounds great. Yeah, thank you so much for having us. It's great to be here. I'm excited to talk about this.
Yeah.
Yeah, I'm Brennan. I founded Vessel Advisors almost 10 years ago. It's crazy, coming up on 10 years in October. And our main focus here has just been to bring financial clarity to business owners who are not CFOs, who are not the accounting side of the brain. And so my background is accounting. It's early stage startups, a lot of venture early in my career, and then being able to parlay a lot of that into value. We've been able to grow this team now to over 80 professionals. And what's fun is that almost every company that doesn't have somebody in that seat gets benefit from having just a different set of outside eyes, on the table. And so I still enjoy doing that, but our team continues to do that for our clients, and excited too about this topic because this is probably one of the more common needs where it really starts to pop up is exit readiness and having financials that are there. I'm based locally, just in Irvine, California, so close by to Plethora. I live with my wife and 4 kids. We're ages 7 to 14, so we're busy, and if we're not working, we're probably on a soccer field. So
Okay.
that's a little bit about me.
So were you guys all part of that World Cup mania this past? Okay.
Yes, Josh as well. He can share. He's got a fun soccer background. But yeah, we all 4 of my kids play. We watch. My kids watch, I think, just about every game, and we definitely planned a lot of things around the final last weekend.
Well, we all have that in common here today.
Oh, that's
It was,
awesome.
it was
Oh,
a, it was a great match. I think great matches, and
it was. It
I'm
was a great
married
World
to
Cup.
an Argentinian, my husband and
Okay,
co-founder.
nice.
And yeah, we were rooting for Argentina, but
Yeah,
got to give credit to Spain. They did a magnificent job at the last game. So
they dominated, but we're big Messi fans too. My youngest had a Messi jersey on all week, and yeah, it was fun.
good. Okay, thank you, Brandon. Josh, tell us about you.
Yes. So I'm Josh Walters. I've been connected with Vessel for about 6 years via close relationship with Brennan. Vessel acquired my firm earlier this year, and I come from an entrepreneurial background, both running my own companies as well as work with entrepreneurs as they've exited to build their exit path. So a lot of the M&A integration from a holding company to a sale, and then vice versa, individual companies bringing them into a larger organization. So operational background, and then also running my own businesses. So that's my background. I've got 4 daughters. I live in sunny California. When their background wasn't showing, I was showing my background, which is, I just, it's someone has to do it. Um, but uh, but yeah, really grateful to be here. Dora, you and I know each other well, and I know your firm and the work you do, so we're excited and grateful for the chance to speak to your team and your audience, because I think we share a lot of the same values, which is let's run a good, healthy business, and if
Mhm.
we do that well, there's lots of options of how we exit in the end, whether that's
Right,
through sale, succession, or something in between.
right. And what's interesting, we've been in this business for so long, is seeing how long it actually takes for businesses to prepare for an eventual exit or a succession. And it's often underestimated. So with that, I like to touch on a topic that many business owners hear about, but they don't always understand. As their companies grow, they often reach a point where financial demands of the business become significantly more sophisticated than bookkeeping or tax preparation. That's where the concept of a fractional CFO enters the conversation usually. So, Brandon, how do you clearly distinguish a fractional CFO from a controller, from a CPA, or that internal financial team?
Yeah, great questions, and it can evolve, over time. But the way that we clearly differentiate the CFO from the controller, at least internally at Vessel, is we think about the CFO as the person on your team who is looking up and out with you. So they're strategic. They're looking at the 12-month, the 24-month, the 36-month, and then trying to pull that, into the current state, often pulling a lot of ideas from a visionary CEO or a founder who has a lot of product or sales initiatives that want to run, and trying to be looking at the opportunity cost of each of those. So kind of the up and the out. The controller is more down and in. So that's day-to-day systems, that's processes, that's controls, that's management of, the AP, the AR, treasury, all the kind of workings of what probably most business owners would think of as their accounting function, roll up to the controller. And the controller's job is ultimately to deliver consistent, precise, clear financial statements to the CFO that can be used to make decisions. Um, Oftentimes we get engaged and a client is working with maybe a bookkeeper or someone else that they've brought up within their organization, and it maybe has that title but hasn't experienced that role outside of that organization, right? So their experience is limited. And in which case they might be using a CPA as kind of another sounding board. We really think more of CPAs, at least in the traditional tax sense, as that's your tax advisor. So their job is to review what's happening and to advise you on how to become most efficient, within the business for your tax side. But when you get to a transaction, right, a lot of those things start to change, and even the advisor, the CPA that you work with, often changes. The expert from a tax perspective on minimizing year-over-year taxes may not be the right person or the right individual to be preparing you for a sale or for an exit, right? To minimize tax liability, for example, in California. And so we separate those things. And at Vessel, we work with, I mean, probably over 50 different CPA firms at this point, but many CPAs, both on the insurance side, on the tax side, the advisory side. And we like to think that we're preparing and making their job a lot easier to say, hey, you have consistent financials that close every month and every quarter and every year. So taxes can be prepared, estimates can be managed a lot faster. And then in the state of a transaction, there's a lot more that will go into that. And then maybe moving all the way down from CFO to controller to bookkeeper. The bookkeeper is really that blocking and tackling day to day. In some organizations, that individual might be called a staff accountant, a senior accountant, depending on the complexity of what's needed in the organization, maybe even an analyst in certain businesses. And their job is really more data and ensuring that the information is getting into the system of record that's being used, and working with that controller on more of a day-to-day, week-to-week basis. That's a little overview of CFO, controller, bookkeeping, and then the CPA as an outside advisor.
So what I'm hearing is a fractional CFO shifts a business from backward looking at the numbers, what happened in the past, to actually forward-looking and financial management? And how do you prepare for growth? How do you prepare for the next product line? How do you prepare for that expansion, if you will?
Yes, that up and out, looking out into the horizon, with the context and the confidence the financials are accurate and prepared by their controller.
Yeah, now many successful entrepreneurs build their companies through like instinct and that experience, a love of a product or a service. They're passion driven. But at some point, that financial complexity just begins to grow faster than their ability to look into it. Josh, where do founders most commonly misunderstand the role or they underestimate its impact?
Yeah. So when a business gets started, I had a conversation about this yesterday with another advisor who's in the HR space. And what was so interesting was we tell the same story from two different perspectives. When you start the business, you're so hungry for sales. You get the first sale, and then you need another sale, and now you have to deliver. But sometimes it happens by luck, sometimes by grit, but they get moving so fast and so quick that the finances are history. And so the finances are more about how to pay bills and how to buy materials and not how to use the numbers to drive decisions. And so it happens at different inflection points, but it seems to happen consistently a lot across most companies is until there's something breaks, they don't pay attention to it. And that breaking sometimes can take the business down. Sometimes it puts the business at a halt. Sometimes it requires significant overhaul. But oftentimes they just get running so fast as entrepreneurs do to take a risk and run forward. And so just like HR or other functions around a business, so often, the entrepreneurs up and running. They're not focused on the numbers until the numbers are what causes them to either not go forward or have to hit the brakes.
It's what we call choking on growth, right? Some
Yes.
entrepreneurs don't realize that it takes money to grow. They simply assume that more sales, more product, more services just automatically brings money into the piggy bank, and it doesn't. And so they start to choke on that growth. What have you seen
Mm.
in the businesses that you help?
Yeah, I can jump on that one. I mean, very, very common within our construction practice to see, that massive growth number. Maybe it's 30, 40, 50%, that they start to trend in a year. Labor costs are increasing, right? The billings that go out, continue to hit the same pace, but that might be 45, 60 days after they've actually put the money out to buy material and to pay labor, right? And so this gap actually just continues to grow. This cash gap continues to grow, even though on the P&L it actually looks fantastic, or the profitability of the business is stronger and stronger. Owner goes, hey, where's my cash, right? Where's the money? And then they need lines of credit. And so speaking back to that CFO level, the job of that CFO is to see that coming, or to say, hey, if the backlog of that business is growing at an exponential rate, or a rate that's different than the prior year, prior quarter, what are we going to need in 3 months, in 2 months, in 6 months to go get? And then they go speak to the bank. They review the financials. They accelerate. Maybe now we need an audit instead of a review in order to get the level of capital that we need, or maybe we need to go to the markets, in a different type of business to do that for equipment financing or purchasing. So I think that's a pretty common one where, yeah, the expectation is more sales is good, and the answer is no. The other is, maybe everything is staying the same, but the margin profile starts to change. So there's a bleed somewhere in the business, and they just assume because they sold it at this estimated, gross profit margin, that means that's what's going to happen at the end of the day, because it's always what has happened. And as a business grows, again, maybe it's just using construction or subcontracting as a good example. That's a really common choke point and an issue that pops up. We see it all the time. So the CFO's job is to help navigate that, to hopefully see it ahead of time if we're coming into a situation where that's already happening, right? To help navigate what capital options are there, what's available to them, what can be pulled forward, and what's most cost efficient, from a interest expense or a dilution perspective.
And for Josh, these are all strategic moves that business owners have to anticipate and make. Where do you see that fractional CFO being key and beyond the reporting, beyond the numbers?
Yeah. So if you think about actually, let me take one step back. Let's separate the difference between a consultant and an advisor. So a
Okay.
consultant typically is on the outside. they give advice, they might give some reports, and then they walk away. They're not part of the team. And oftentimes what we find is, yes, the financial insight we deliver, the ideas and concepts we can help them ideate and strategize around, those are all significant, but they're missing that function in the business, that leadership function. So someone who sits at the table with them with the perspective of finance. And so that missing function ends up being a key part of the business, right? So decisions, start. It's not just the time we walk in that the value is there. The value was a whole before. So if now we're looking at it as someone's at the table with us, thinking about finances, strategy, looking ahead, that becomes to impact culture.
Mm.
So now you're not just hiring someone who can come in and help with the finance strategy, but also they've been there, they've done that, and so there's a cultural impact too. And a lot of owners. I mean, listen, I can speak to myself. We're not always the brightest people. We're just risk takers, and so having someone who is sound and level-headed and understands finance around us is invaluable. So, for the owner itself, for the team, there's a cultural and strategic impact that exists when they're on the bench with you.
So as I'm seeing a fractional CFO, and Brennan, Josh, correct me if I'm wrong, I'm seeing an extension of my team. I'm seeing someone that comes in and sits with my finance team and with my sales team and production lines and say, okay, guys, these are decisions we need to make in order for this company to continue to grow healthy and survive. Is that how you see it, or is it more of I meet with the CEO once a month and that's where our job ends? Us.
Yeah, I think that's a great clarifier. So I think in the industry there is that, hey, we show up once a month. You get a fractional CFO for like no fee at all, and almost no fee at all, and they're showing up for an hour at the end of a month and kind of reviewing the financials live with you. That is probably better than nothing. But what we're talking about is more of a trusted partner, an
Right.
extension of the team. I love that language. We've used that in our deck over the years before too. But talk about being a trusted partner, like almost like we're the owner at the table without the equity,
Mm-hmm.
because most of our team has either been in the C-suite for 10, 15, 20, even 30 years. They've owned their own businesses and they've been a CFO in different businesses. So they actually empathize and understand the pain or the impact of some of these issues.
Right.
But yeah, I'd say to the extent that most of our clients, it's either daily or at a minimum weekly, where they're having interaction and engagement. And in some cases, right, the CFO's job is to be that up and out advisor, but a lot of the execution that needs to happen maybe can't happen with the current team, or they don't have the resources to do that. So again, Vessel might come in and be that controller on a fractional basis, and so the CFO and controller are working together, day to day, week to week, and then with the owner maybe week to week or every 2 weeks, depending on the need
Yeah, and
and
depending on
frequency.
the complexity of the business too and
Mhm.
the kind of cycles they're running. Now,
Yeah,
that brings another topic on everyone's mind today, AI. Business owners are hearing about it daily. I mean, the last 3 years have been transformative in finance and in accounting and so many service industries. Where do you see AI creating meaningful value inside these organizations today? And where does experienced financial judgment remain irreplaceable by this machine that's all
yeah,
knowing? That's a
great question.
generative AI.
I am spending a ton of my time the last 18 months in this space, in this issue, because like probably you and everyone else on your LinkedIn feed, your X feed, your whatever feeds you're using, it's what's coming up, right? They know you're a business owner, they know what your questions are. So um, to the what's working side, I think existing manual processes that are already documented, very easy for the most part to manage through.
Mhm.
We see this when we come in and do assessments for clients. We look at people, we look at process, and we look at technology. It's under that process function, right? We're looking to see, do they exist? If they exist, are they being followed? If they're being followed, can we make them faster, smoother, or is there a best practice? And so I think that's the niche. I'd say since February, roughly, since Claude and Cowork really hit and are being better understood and utilized, not just with maybe business owners, but others across the team. That's where we're seeing the most meaningful immediate progress. This thing used to take me an hour. Now it takes me 5 minutes to review an output, or I can have it run, once a day. Um, Interestingly, where we're not seeing it working is in the technical bookkeeping and accounting yet, which is frustrating because we reviewed a lot of different tools and softwares. And just this morning, I was on a call where we're trying another one that has a great mix, for QuickBooks and Stripe, which is, a lot of clients that start, that are smaller, they're early stage, maybe pre 10 million. That's a pretty common setup for payments and for bookkeeping. And you think, hey, how hard can it be? Well, you have costing, you have everybody has a different set of chart of accounts. Everyone has a different set of rules. Everyone has different banking. And so there are custom tools that are being built, and then there are also ways that you can do this within your own Claude instance. But it's a build it yourself model, and then you become the QA manager as well, almost like you have your own software company. So there are pros and cons of this. Probably the best one I saw yesterday was Claude getting to the point where it's hey, the accounting and small business function, it's at 79% accuracy for accounting. That was kind of a broad score. And we said, well, 79% in accounting is 0% useful. When it gets to
You need
99%,
100% accuracy.
yeah, 99, 99.5, 90.9, ideally, right? 100% we'd all love. But that kind of when we get to that level, that will be fantastic because then that's more of the controller overseeing a team of accountants, or maybe a part-time controller that can oversee, or a fractional controller that can oversee what used to take a much larger team. In my experience, again, over the last 18 months, and I'm probably spending anywhere from 5 to 10 hours a week, in this space. That's I think the tease is still there. We're trying to get there, and part of the value too of having Vessel. We were discussing this morning as a team. Is we were looking at a tool that we all really liked and had a lot of promise, and it is not going to work. Like, and we worked out why, and we're candidly all just disappointed. We're like, this was supposed to be the one that would solve, maybe 60% of the issues that we have been trying to fix on. And the value there is that we've gone and through the pain and done the homework and realized it. And it doesn't mean it's not going to be great in 2 weeks or 2 months or in a year. But that as of today, we would not recommend it to a client. We would not use it ourselves. So I think that's kind of where we're at. The larger companies that have the ability to really fully build something from scratch. There's some great AI native softwares that are newer to the market, like Campfire or Puzzle. They're definitely worth looking into. And so for companies that are brand new and starting, I think there's a lot of opportunity to kind of jump in and just build it from scratch there, and you don't have to go to QuickBooks. But for companies that are more established, that have decided they're on a larger ERP, a NetSuite, you're going to want to be using agents and tools that QuickBooks, even Enterprise Suite or that NetSuite, Sage Intacct, that they're already building into their tools. You're going to want to just stay on top of that and continue to incorporate the AI automations are already included in your software. So as tight as I can put it in maybe 5 minutes, but there's a lot there. We could probably do an entire couple hours
An entire
on that
session.
topic.
And I think as for CEOs, don't underestimate the time it takes to actually learn and get immersed and understand the technology around it. And then how, without having that proper training, identify where there are errors within the AI outputs, right? Because they hallucinate, they make up stuff to accommodate the narrative.
Yeah, and it's getting better. Just last week, I was looking at an example of this where, as you can imagine, follow a lot of people on LinkedIn and online that are in this space in accounting, testing out these different tools. And Claude and I use Claude every day, but Claude will have this output that has this perfect reconciliation, just as a very basic example of an account. And then you can prompt it back and say, okay, now find the errors. Find where you messed up, and it'll go through and it finds 10 errors, finds 12 errors. And so the assumption, I think, of someone who either doesn't have an accounting background or just assumes that it's right, just like with anything, this could be content, this could be any other
Right.
HR legal portion of your business. You don't have a little bit of context, like that human in the loop with the right experience. Thankfully, you don't need as much of it anymore, but you do need that person to sit there and go, okay, that's inaccurate. I can tell that. I can tell you that, and with 100% certainty, let's fix it. You still get the output quicker. But yeah, so we encourage every one of our clients, to the extent that they're comfortable with it, to be playing with these tools, using these tools. I think the other thing that we're seeing is in, like the management discussion analysis, the FP&A, some of the things that are a little bit more algorithmic or specific in reporting. If you have like a public company and you're reading through quarterly, it's got a very direct structure. AI is very good at that, summarizing that, having that type of information. Candidly, we find that our clients don't read those reports. They don't want that information. They want what are the 3 or 4 bullet points, like show up to the meeting with the things we need to discuss, what we need to do. And so I think that's also maybe that CFO layer, or that, whatever C-suite layer it is in your business, that CEO wants to know, okay, what should we discuss? Like, don't give me the report, give me the 3 or 4 things we need to work through, the issues we need to process.
Okay. Yeah, there's a lot to learn there. So now, Why do many owners wait too long, and what are the consequences of delaying the need to bring in a CFO? You know, Josh.
Yeah, I think it's the entrepreneurial journey, right? We start off without a lot of knowledge and clarity. We don't start off with all the systems in place. We start off with what we need then.
Hmm.
So really what we've seen is they get to the breaking point, and unfortunately sometimes it happens very late in the process, and it's like I don't know how to continue. I spend most of my time speaking with clients who are just engaging with us, and sometimes it's too late, and it's sad that it's gotten to that point that there's without a infusion of cash, there is no solution because they're so far behind. But it's hopefully, it doesn't get to that level of pain that early on it's like, hey, I don't have the clarity I'd like to have. Sometimes it's turnover. Actually, I spoke with really incredible entrepreneur yesterday who he's a physician and had this itch to scratch his entrepreneur itch. And so he bought a franchise, started a business, and he's doing awesome. But he's realizing that as he's gotten all the success now in this new business, he there's so much he doesn't know. And so really for him, the alarm was the fact that he's hired several accountants internally, and they're not solving the solution he has. And yet he also doesn't know what that problem is entirely. So it was exciting to hear him, first of all, his openness to solving it, but two, the fact that that was the pain point is hey, the turnover was a sign. Uh, and that's one of the indications we get sometimes. We get called because someone says, "Hey, I just lost my so and so, my CFO, my controller. Can you help us out?" That's a we should ask ourselves why someone left. Turnover is not a good thing. It can be, but it's usually not when it's a surprise. So
Right.
looking for those signs, whether it's a I as the owner am having to write a check to pay payroll this week. Um, right? There's no money in the bank to buy material. Like those are signs. Those are late signs that should be found a lot earlier. But I think that's often why people wait or delay. Um, the nice thing actually right now in the season is, we address this sort of what is a CFO anymore, and a fractional CFO is a lot more common of a concept. But again, it can take on a lot of different forms based upon who's using it. And so, at the end of the day, is get help. Don't run blind. It's not just your own livelihood; it's the livelihood of all of your employees and their families.
Yeah, and I think you touched on something in a prior conversation you and I had is that most business owners don't know what they don't know, right?
Yeah,
And so,
yeah,
especially, that you're a great entrepreneur, you're a great designer, you're a great salesperson, you deliver great product, but necessarily in the finance world, there's so much that sometimes we don't know or we fail to see because of that lack of knowledge. And I think that's where a fractional CFO comes in so handy. It's a trusted partner, it's a trusted advisor. So
Yes.
I think this one will go on to you as well, Josh. So when a business owner is contemplating a financial event, and that could be refinancing some debt, growing through acquisition, raising capital to make that next investment, or an eventual exit, what is the main value in hiring a CFO at the table? Why is this financial preparation so important and
well,
often
I think
overlooked?
I mean, Dora, I think you can almost speak to this better than me because you sit with owners as
Yeah,
they are looking to sell, and it's not so much that I don't love everything private equity, but they do some things well. But the fact is, they're experts at buying businesses,
right.
and so on the other side, if you're not an expert at selling and preparing and telling the story through the numbers, they are. So
Yeah.
it's kind of like we'll go back to soccer. If we look at some of the teams that left in their first round versus the teams that made it to the end, there's no comparison, right? They're
That's
not
right.
they're not on the same level playing field, and so I think it's just that you need an expert by your side who can help you
Mhm.
not just do the work, but frankly, you need to understand it as well because you still know the business, right? The level we bring in is the financial, the accounting, that side of things, but you still know your own industry. Yes, there's industry
Mhm.
knowledge that's important, but you know your business and how your business is different. And so if you're going to the table to get to a deal, You want the right partners. You want your investment banker. You want your financial advisors. You want your CPA because you need to know what the ramifications are after the sale. But that's why that team is so
And plan
critical.
for it. Yeah.
Yeah, yeah. It's not something you should do on a whim. It's
Hmm.
something you should come to the table prepared for and know what the opportunity looks like.
And I think you touched on private equity and why they're such great partners when they acquire companies because they do focus on the number. They don't just look at where a business has been and where it is. They look at where's that business going? Because at the end of the day, if that business is growing, there's going to be cash flow to retire the debt of that business after, post acquisition. Um, and in that preparation, we encourage business owners, get your financials reviewed. Better yet, get them audited. Because when it comes to selling your business, it could probably bring you 2 or 3 times more in multiple, simply because of the reliability of those numbers.
Hmm.
And I think I would have to add the same with a team that has a fractional CFO at the table is that buyer is looking at that business with a different set of eyes. They're looking at that business with a seriousness of growth and projections, forward thinking, right? And at the end of the day, that's what a buyer buys is future income flows.
Yeah, I mean they're reviewing the management team too, right? And so sometimes that's a gap at the table. They've got a really strong CMO, they've got a really strong leader, they've got a strong head of sales. The different departments are handled. They've got R&D or they've got development, CTO, CISO, but that finance one is still an accounting manager or someone who's never been through a transaction in their life, and that I would argue candidly is a problem during diligence to be reviewed by someone in the PE space, and they're going to ask questions that that person's just never engaged before, versus
Mhm.
having a fractional or advisor in there who's been able to do that. I think too, getting ahead of some of the common problems, like even just how your gross margin is reflected and at what level of detail in the P&L. What's your conversion cycle? What's your like how much networking capital is required? Understanding how that kind of works at the end of a deal. These are all brand new things to someone who's never sold before. And so there's a lot of kind of that I don't know what I don't know intangibles that come to the table when you have that person sitting there, because they're those outside eyes going, hey, there's three other things you need to consider here, right? Because I heard your number is X. Well, at the close, they're actually going to take another this for that. There's a escrow, there's some at-risk capital here that's not clear to you, or just setting expectations. You're not going to sell 100%, in those cases. So how does that change your
How does that
your
change?
thinking?
And that
Yeah,
quality of earnings. And I think
yeah, your QV.
sellers often underestimate the level of scrutiny and granular detail that buyers require, especially with the larger companies. Product line, gross project by product line.
Yes.
It's and
And
if
by
if
customer,
it right
often
and
by
per
customer,
customer,
the customer
right?
by customer, line by month, revenue actuals, projections, LTV or CLTV. Like there's a lot of things they're breaking down, and they'll if you're not already looking at those trends, they're going to find them. And from LOI to retrade or to close, those are going to be some of the
Yeah.
conversations. So again, if you have the time, 12 months plus, that's where the CFO can come in, or someone can come in and assess what's going on and say, here's some gaps, here's some things you could add back, here's some things you're running through the business that either you probably shouldn't, or need to be broken out differently, so that you can start operating the business and understanding what the true maybe EBITDA is or true net operating income is, as opposed to what you're leaving on the table, right? Every
So with
dollar is
some
a
of the
multiple.
clients you've been working with, as you're preparing them to refinance debt or take that next decision, whether it's succession or acquisitions, um, what's the timeline that it takes for you to actually come into a business, assess it, understand how it's running in the finance department and in the accounting department, and implement changes where the whole team is comfortable moving forward?
Yeah, great question. I'll take this one, Josh, but feel free to
Yeah.
jump in if you'd like. Our core offering there is around a financial discovery assessment. So we come in and we'll look at people, process, technology. We'll collect a lot of the documents that a client for, let's say, an investment banker would typically have to send in, right? That's everything from financial statements to org charts to contracts to legal structures, all like for us to understand what's going on very, very quickly. And we analyze all those things prior to coming and being on site with the client. And we, as kind of a phase two, we spend a couple of days on site with the business, meeting one-on-one with everyone from the business owner down to the junior accountant, bookkeeper, kind of entry level position. We're trying to understand a lot of different things, but we're looking through the lens of people, process, and technology. And again, from that CFO looking up and out, and that controller looking down and in, like we talked about before, and come back with a set of recommendations. They say, hey, we observe these 10, 20, 15, 30 things. We want to recommend you make this change. And then to the right of that in our report, we include a dollar value. What
Okay.
that means is it says this is the dollar value of this recommendation if implemented over a 12-month period. So sometimes that might be a one-time event. Sometimes that might be a reoccurring every year because we've now taken something that used to cost $10,000 a year, $50,000 a year, and now it costs zero, where it's automated with a tool or technology or a better process. And so that's the point where the client then gets to decide whether or not they want to go execute this plan themselves, or if they would like a team to come in, which is usually us to come in and help support that. Occasionally they need full time, so we'll help them potentially hire a full time person as well. So that whole process takes about 8 weeks, 6 to 8 weeks, probably on the tall end. From there, I'd say it ranges. It can be 2 or 3 months if the client really wants to move aggressively and to implement changes, so we can show maybe a full quarter of either actual detailed results and maybe push for those in a sale as true add backs. In other cases, maybe 6 months, 12 months, even 18 months, just depends on the pace. And that's sometimes can be more of a function of cash as well. If the business is cash constrained, right, we're going to do the highest and best use things up front and maybe do some of the nice to haves a little bit later on in the process. In other cases, if someone came to us today and said, hey, I need to be, on the market, on November 1st or January 1st, we're going to have to kick into a little bit of higher gear to move into execution. It also depends on if the client wants us to be involved in a active role or if they want us to be involved in an advisory role. Sometimes we come in, they have a great controller, a great person who's just doing a phenomenal job at what they know, but they just haven't been that deal CFO before. Great. We'll sit in that seat and we'll continue to support and teach and train. In other cases, there are gaps there, and so we'll help the client either kind of repurpose that role, or, reorganize that role, or in some cases take it over.
From the business owner that's contemplating a sale, trailing 12 months is critical in
Yes.
that process because buyers are looking at, okay, we know where you've been, we know where the growth is, but we want to continue to see that trailing 12 months. And oftentimes business owners underestimate how long it takes to actually go through a process from the moment you get your letter of intent till you actually successfully close on that transaction. Could be 3 months, 6 months,
Mhm.
assuming
Yeah.
no major hiccups
No
along,
hiccups. Yeah.
right? So that confidence impacts more than valuation, right? It also influences the deal structure, the financing term, the due diligence outcomes. Um, Josh, what role does forecasting and KPI tracking play in showcasing a business to a potential buyer?
I think it's as simple as it's setting the true north. If you're not chasing your KPIs, what's your team heading towards? And so the criticalness of knowing that, one, they're in place, two, they've been tracked, and three, that during the process of a sale, in the preparation for sale, that you're still chasing that because things don't stop. Like you just mentioned, the process of a sale can go long and often longer than you estimate or anticipate. And so you need to stay on track because falling off track is absolutely going to cost you something in the sale.
Right. And that's something we tell business owners, stay focused on your growth. Let the rest of the team supporting you worry about the details of the reports, right? Working with the fractional CFO is always a great partnership because they understand what it is that private equity is looking for, what kind of reporting, and then they're able to take the time and work with that finance team within your organization to deliver those kinds of reports and make sense of them. Not
Yeah,
just
well, and,
deliver the
and you
deal.
just mentioned 3 to 6 months. I'd say when we come in and do assessments, it's pretty common that business owner, I always look at the year end. Like that's like a closing. How do we do for the year? Quarterly, maybe two, and rarely really monthly. Or if they do look at it monthly, it might be
Hmm.
45, 60, 90 days after the month is really like, it's the team has formally closed it versus 5, 10, 15 days, which would be more kind of best practice standard depending on the industry. And so what happens is when you get into diligence, right, there's an analyst who shows up on day one and is asking for everything, gets all the documents and details, and then says, well, you forecasted this, and here are all the areas you're off. Tell me why. And oftentimes, like if you didn't work with an outside fractional or you hadn't gone through a transaction before, you're probably not looking at that monthly. You're probably not asking those questions. You're not thinking, oh, I got to hit my number this month. Well, if you get into diligence and then you're in the second or third month and you've missed one or two or God forbid, three, guess what's going to happen? It's getting retraded or you're falling out. Like it's not going to happen. So that's, I think, part of like Josh talked earlier about the culture that a strong financial team brings, just the comfort too of a CEO and founder who's, hey, I've been doing this for 12, 18 months, 24 months even. I know every month we sit down, we go through the numbers. We've gotten better at revenue predictability. We know where our margins are. We fixed a whole bunch of these little problems so that when the analyst starts asking questions, sometimes it's not even the CFO on Vessel's team answering them. It's the owner. That creates a level of confidence to check the box, that the analyst and the buyer can go. From a diligence perspective, this team, they not only have good numbers, they know their numbers, they can answer the questions, they have supporting documentation, they know when these things happen. And that's a consistency, just like anything else. It's a skill that's built. So yeah, I'd encourage anyone who's, if you're a couple years out, great time to start thinking about it, even at a lightweight level of budgeting monthly, looking into look out 12, 24 months, but break it down by month and really take the time every month, either yourself or through someone else in your team or a fractional to assess and analyze those variances and fix them, because that's where the money's hiding.
That's it.
Yeah.
Someone once asked me, and I heard this at a presentation, when should a business owner start to prepare for an exit? And the answer was mind-boggling. The day you start your business, right? Yeah. And so I think business owners, if they were to take that approach from day one, and okay, so you haven't done it, you didn't do it in day one, start today. It's not too late to start thinking about running your business as if you were exiting at the end of the year, if you were exiting in 6 months, because then it'll make you a better CEO. It'll make you a better business. It'll prepare you for that growth and whatever comes your way. Along with that is the concept of, and I'm throwing this one out, and I know we haven't discussed it, structure, deal structure. Earnout is a common part of a deal structure when a business owner goes to sell. So in knowing that, why is it so important for those financials to be so accurate and for that CEO to understand what drives all those numbers? Because it'll ultimately impact how they get paid on that earnout.
Yeah, absolutely. I can take a first stab, or Josh, you want to take this one?
No, go for it. I mean, the answer is straightforward. It's your toolbox, right? If you're going to war, you're going to battle, you're going to have a conversation, or even if it's a friendly conversation, this is everything you have. So all you can stand on is numbers. And so everything else, which is IP, which can be protected, and some of it's just intrinsic by culture, et cetera. But everything else is numbers. So it's all you got.
Yeah.
Yeah, I like that a lot. I think that there's a perception, like earlier I mentioned, like we'll talk sometimes at the start of an assessment and we'll ask our goalpost question, where are we going directionally? And that's what we're trying to say. Do you want to sell? Do you want to sell in the short term, long term? Is it a 1 year, 3 year, 5 year, someday? Others, that whole side of the envelope is not something they ever want to do. They want to keep it in the family for generations. We have a lot of clients that are second, third, fourth generation businesses. Mm-hmm. We come in and say, hey, you run the business as you're doing it. Let us be that outside investor, mindset. Let us have the assumption that you're going to sell, even if you tell us it's going to be in the family for 200 years. Let us look at it as that outside party who's constantly pushing. And that way, when we're at the table, we're bringing that perspective. It doesn't mean you need to take it as a business owner, right? If you want to take the trip, do the thing, buy the equipment, if it's your business, right? We don't dictate what you do. I think that's another perspective maybe on the whole side is you want it at the table. I love the idea of it as day one. We have an investor we work with who has a concept called exit hours. And his whole idea is, when you start a startup, be thinking about who your buyers are and start talking to them, in the first 6 to 12 months and have the conversations. What are they looking for? What's evolving? What's changing? Yeah, it's a little extra work up front, but it gets your mind in that mentality. And I think the best business is if you can sell it and don't have to. that's fantastic. Or if you're in a position that you didn't expect to be, health related, I've seen a lot of like family, dynamics that come into play. It's like, the thing we need to do actually to clean this all up is to exit. And if they're in a good position, they've been running it as though it's either investor grade financials and investor grade reporting and the whole legal structure set up. That's a very smooth process. On the other end, if it's not, it's fire sale. And this thing that maybe someone spent decades building and thought was worth 20, 50, 100, $200 million is worth a small fraction of that. And it's a result of things that could have been prevented earlier on.
And I think you touched on preserving those legacies, right? Especially in generational businesses.
Yes.
Bringing in a fractional CFO brings in a second set of eyes, a different kind of discipline and accountability to an exterior person, yet part of the team, right? And so don't
Yes.
underestimate that, the immense value in training that next generation to take over the business with a different mindset of this is not a business that's been in the family. This is a legacy, and we need to preserve it.
Yeah.
Yeah.
Yeah,
Josh,
that's right.
Brandon, any case studies, any examples of companies you've worked with that sort of ties all of this in for our audience before we close out?
Yeah, Brendan, why don't you share a story? I know we can't share too much, but we had a client who thought they were quite a ways off from being able to exit, and they wanted to exit. And Brendan can tell the story
Mm.
a little more, but
Yeah.
yeah, amazing results. And again, it changed their world.
Yeah, great example of kind of just, hey, I don't know what I don't know. I've got a vision. I don't really have a map yet. So again, we got engaged. This was someone in ecom, and they wanted to eventually sell the business for $100 million was their big picture goal. That's the exit, not walk away, but just the top line that would be sold for. They were fast growing. They had great top line growth, growing 45 to 60% a year. Their gross margins in that space were about 10% above what others were. They had great payment terms. They had multiple suppliers. They didn't have concentration. And so we're sitting there that first day going, this,
Good deal.
you got a good thing going. They grew exponentially, for about 3 years. They were kind of a small little thing for 3 or 4 years and then started growing exponentially. And we came in, I think, at the end of January, early February of a year. And we said, kind of coming back with the assessment, if you continue on the path that this hockey stick that you're on, you're gonna be like in a 70 to $90 million valuation by the end of the year. So you're not that far away from that if you want to start thinking in that perspective, because they thought this was a 5 year, 8 year goal, had no context. So just that information is useful. They don't need to go meet with 7 bankers to get that rough information. They took a month, they thought about it, 2 partners, and said, you know what, yeah, we do want to, we're not committing to it yet, but we want to have some conversations. And so we made some introductions to people that do transact in that specific niche space, and that conversation led to a couple more conversations, and all of a sudden by June they made the decision, yeah, we want to go out in January. So what do? Right? We kick into high gear, we bring in the tax advisors, the attorneys, all the people that are going to need to be at the table for that transaction. And they exceeded that goal for the year. They were well over a 10x multiple. And they sold the business, in the middle of that next year. So I think the value there in the case study being, if you don't know what you don't know, even if you have a vision for, let's say, like I think a lot of clients we talk to, it's 5 years out, they'll throw a number, 7 years out, I'll sell, 10 years out, someday I'll sell in the relatively near future. You start backing into the math and what their quote unquote number is, or what they want to get to. And it's the gap isn't that hard. And if we can have the discipline financially to do these things, to look at the OpEx a little bit more carefully, to take away that customer or vendor concentration risk, to like just strip out the problems we know are going to come up in diligence for a buyer, you're going to be able to be on the upper end of that multiple. So that's the value of sitting with somebody. And candidly, even if they had said, no, we don't want to change anything, I still think that there's a lot of value there. Just having another person at the table who sees the world maybe just a little bit differently, looks at the business differently. They're not enamored with the product or the vision or all these things. We're just looking at it from a spreadsheet and valuation perspective. I think that's a good person to have at the table, regardless of if you're going to
Because you
sell
take
in
the
6 months or
emotion
five
out,
years.
right? You take the
Yeah,
emotion out.
Exactly.
So they
and
set
the
out with a
bias.
goal. 100 mil, right? That was the goal with your client.
With the client.
You know, it's hard to admit, but we've been in this business almost 3 decades, 28 years since we founded this company. So we've been
Awesome.
through the economic cycles. We've been through the tariffs. We've been through the terrorist attacks. We've been through all of it. And so many times when businesses were that close, like the one you just described, Brennan, had they made the decision, okay, let's pull the trigger now, and they would have completed a sale. 6 months down the road, something happens that would have wiped out a third of their value. And so back again at the
Yep.
grinding
Yes.
wheel.
COVID. Yep. All
So
those. Yep.
all of
Absolutely.
that. So I think,
Yeah.
gentlemen, I'm so impressed with the information you're providing to our audience and the information you're bringing, because it makes it real to the CEOs at the table that are not so focused on the big picture, but focus more on their day-to-day running of their business. I want to thank you. And in closing, Josh, I'd like to have you do some words, and then Brennan, and then we'll take it from there.
Yeah, I think that the summary is this: like, running a healthy business is going to lead to a healthy exit. So whether you are doing that for the planning now with a goal in mind, or just running a healthy business, everything we talked about falls into that.
Mm-hmm. And Brennan?
Yeah. I'll echo Josh. He's got it much more concise than I know how to do. But really appreciate you making the time too for us to come and just speak to your audience. And it's a pleasure working with you. So thank you very
Thank you,
much.
gentlemen. And the information for Brennan and Josh will be available in the presentation. Those of you in attendance or that register will receive the presentation. Thank you so much, gentlemen. And until we meet again,
Thanks, Troy.
thank you to our
Bye.
audience. Bye-bye.